Welcome to Topic 7, Consolidations Part 1. Consolidations is about accounting for more than one entity. We will learn about parent and subsidiary entities. In this topic, I'm going to acquire your business. Therefore, a parent and subsidiary relationship is formed, where I'm the parent entity and you're the subsidiary entity. After the acquisition, we become an entity, or in other words, we are now a family, where I'm your parent, you my children. As a parent, I do have control over you and your activities. In this topic, we'll learn about accounting for parent and subsidiary relationship. Now let's look at the definition of control. As a parent, I must have the ability to use my power over you to affect the returns received from you. I must also be able to use my power to increase the benefits and limit the losses from your activities. AASB 10 requires that some variable returns be receivable, and the parents by actions can affect the amount of these returns. AASB 3 paragraph 18 requires that identifiable assets and liabilities of the subsidiary are to be measured at fair value at acquisition date. Therefore, we need to compare carrying amount of our assets and liabilities to the fair values. If carrying amount is lower than the fair value, we will need to revalue up to the fair value. If carrying amount is higher than the fair value, we will need to revalue down to the fair value. I'm going to work through exercise 27.9 to show you how we prepare acquisition analysis as well as consolidation worksheet entries. The date of acquisition was 1st of July 2022. First, we need to show the net fair value of identifiable assets and liabilities, where we have equity minus the goodwill because goodwill has been recorded. Remember the requirement that assets and liabilities are measured at fair value. So that means that we need to compare the carrying amount of our asset to the fair value given in the question. In this case, our inventory needs to be revalued up to the fair value. It's an upward revaluation of 3,600, therefore we plus 3,600 net of tax, and that will go into the BCVR. BCVR stands for Business Combination Valuation Reserve. The same applies to equipment. There is an upward revaluation for equipment to the fair value, therefore we add the difference to the net fair value of identifiable assets and liabilities. The same applies to other accounts. Then we'll come up with the total net fair value of identifiable assets and liabilities of 218,070. Next, we consider the net consideration transfer, basically how much parent pay for the business. We must consider the dividend, the 60% of dividend. As the dividend was declared prior to acquisition and the acquisition of the remaining interest of 60% is cumulative dividend, this 60% of dividend is recognized as a refund of consideration transfer. It is assumed that the other 40% of dividend related to the previously held interest was already being recognized by the parent prior to the acquisition as dividend receivable. So by using the net consideration transfer and previously held equity interest, we can work out how much is the goodwill acquired. Remember, in this question, we previously recorded a goodwill of 5,400. Therefore, by using the goodwill acquired minus the recorded goodwill, we know that the unrecorded goodwill is 3,300. Now, let's look at how we prepare consolidation worksheet entries. The BCVR entries at acquisition date will need to recognize adjustment to fair value for inventories and equipment. Remember, we revalue the inventory up by 3,600 to the fair value. Therefore, inventory is now debited by 3,600, and we take into tax considerations. So BCVR is net of tax. The same applies to equipment. However, because equipment being a non-current asset, we must first write back all the accumulated depreciation for the asset at date of acquisition before we account for the revaluation. So we have an upward revaluation by 4,500, therefore we debit equipment and credit BCVR by 3,150. The same applies to patents, where we debit patents by 45,000, credit the deferred tax liability, credit BCVR 31,500. We also have in-process research to account for. Remember, the BCVR is net of tax. Then we have the guarantee payable, which is a liability. Therefore, we debit BCVR, debit deferred tax asset, and credit to show an increase in liability. Next, we need to write back goodwill that was previously recorded. To do so, we debit accumulated impairment losses for goodwill and credit goodwill before we account for the unrecorded part of goodwill acquired. So we debit goodwill 3,330 and credit the BCVR entry by the same amount. After that, we need to go through all the BCVR, such as inventories, equipment, patents, research, contingent liabilities, and unrecorded goodwill that we just created to work out the total figure for our BCVR. I know that it's a long process. You will disagree with me if I say that this is a piece of cake. So we debit retained earnings, debit share capital, BCVR, and finally credit the share. So this is our pre-acquisition entries at acquisition date. We must also include the dividend payable, debited by 4,500, and dividend receivable, credited by 4,500. This concludes topic 7. I hope you like consolidation as much as I do.